Imagine owning a business where people voluntarily hand you their money. You use part of it to issue loans, and then you charge interest for access to that same system. That is what it seems like to own a bank. But do not be mistaken. Buying the building, installing a vault, and hiring tellers is the easy part. The real obstacle is obtaining one of the most closely monitored and valuable licenses in the world, proving that you have millions of dollars, and convincing the government that you can be trusted with the savings of thousands of people. Even after accomplishing all of that, a single mistake could destroy your bank in less than 48 hours. So why are some investors willing to risk everything to enter this business? Opening a bank does not begin when you receive your first deposit. It begins much earlier, when you try to convince regulators that you deserve to control the money of thousands of people. Preparing the application process alone can cost nearly $500,000, approximately $200,000 in legal fees and another $300,000 for consultants, financial analysis and market research. You will then have to submit a plan so detailed that it may run anywhere from 800 to 1500 pages. In it, you must explain where the capital comes from, who will manage the institution, how you will prevent fraud, and what will happen if customers try to withdraw their money at the same time. The review can take between 18 and 24 months, and approval is never guaranteed. But if you make it through the process, you will receive something far more valuable than a vault full of cash: legal authorization to accept deposits and turn part of that money into interest-generating loans. However, investors with enough capital often choose a faster path. Instead of building an institution from scratch, they purchase one that already has a license, customers, and active operations. In January 2025, a California company paid $64.6 million for Cornerstone Community, a bank that managed $658 million in assets. Community banks generally sell for between 1 and 1.5 times their book value. That means acquiring a bank with between $200 million and $300 million in assets could require an investment of nearly $40 million. You are not simply purchasing offices and bank accounts. You are buying time, trust, experienced employees, and the authorization needed to operate from day one. In some European markets, the barrier to entry is lower. Certain specialized licenses can be obtained with between 5 million and 10 million euros in regulatory capital, which explains why many financial technology companies chose Europe as their starting point. There is also an unexpected difference. Bank robberies are much less common there. The United Kingdom records around 100 per year, while the United States reported 1,362 in 2023. That number may sound alarming, but the armed robber who walks into a branch is no longer the major threat portrayed in movies. Over the past 20 years, bank robberies have fallen by nearly 80%, and the average amount stolen is only around $5,000. The risk still exists, but it is no longer a threat capable of destroying a bank on its own. Even when a branch is robbed, the loss is not covered by the FDIC. That protection takes effect when a bank fails and is designed to protect customer deposits. Stolen cash is covered by a different mandatory insurance policy known as a financial institution bond or banker's blanket bond. In other words, the money can be recovered. When a bank is robbed, the insurance company replaces the stolen funds and decides whether to pursue recovery or take legal action against those responsible. That is why bank tellers receive one very clear instruction: hand over the cash without resisting. Money can be replaced, a life cannot. But armed robbers are far from being a bank's biggest problem. To open one from scratch, you need approximately $20 million, around 2 years of regulatory procedures, and an infrastructure capable of handling mandatory insurance, audits, regulatory controls, and fixed costs that will continue even when the business is losing money. Buying an active institution can eliminate the waiting period, but it could cost you around $40 million. With an investment that large, the question is unavoidable. What privilege could possibly justify all that risk? The answer becomes clear when you understand what actually happens after you make a deposit. If you place $1,000 into an account, the bank does not keep those exact bills inside a vault while waiting for you to return. That money becomes part of a much larger system involving assets, payments, reserves, loans, and liquidity. In March 2020, the Federal Reserve reduced the formal reserve requirement for certain accounts to zero. This did not eliminate capital, solvency, or liquidity requirements, but it made one thing clear: banks do not operate by keeping a cash copy of every deposit. Their true power lies in credit creation. When an institution approves a $200,000 mortgage, It does not need to remove that exact amount from a cash drawer and physically hand it over. It records the loan as an asset and credits $200,000 to the borrower's account. At that moment, a new deposit appears within the system. Money is created when the loan is issued and reduced as the debt is repaid, always within the limits of capital requirements, risk controls, and regulation. And this is the privilege that makes a banking license so valuable. The institution can charge interest on the credit it has just created. To understand the business, imagine that attracting $10,000 in deposits costs the bank $50 per year in interest. It then uses its funding capacity to support an equivalent mortgage that generates $700 per year. After subtracting the cost of paying the depositor, the bank is left with a difference of $650 before accounting for other expenses and risks. This gap between what the bank earns from its loans and what it pays for its funding is known as the net interest margin. At a small institution, it may be approximately 3.5 to 4%. That percentage may seem modest until it is applied to hundreds of millions of dollars. At a massive bank, a small difference between interest rates can become tens of billions of dollars every year. But money is not the only valuable asset controlled by a financial institution. It also knows its customers with extraordinary precision. How much they earn, where they shop, what debts they carry, and how they behave with money. For many industries, that information can be almost as valuable as the deposits themselves. The problem is that a large portion of our data also circulates outside the banking system. Every website registration, every data breach, and every forgotten account can leave names, email addresses, home addresses, and phone numbers stored in unknown databases. As a result, scammers and identity thieves do not need to search for victims at random. They can select them using information accumulated over many years, and when someone applies for credit in your name, you may discover the fraud much later, after the debt already exists. That is the problem Incogni is designed to prevent. The service finds and removes your personal information from data collection companies, as well as from specific websites that you can identify through its custom removal feature. You simply submit the link, authorize the process once, and the specialist handles the rest. If your information appears again, Incogni automatically submits another removal request. You can also try the service with a 30-day money-back guarantee. Visit incogni.com/millionaire or scan the QR code and use the code millionaire to receive 60% off. Now let us return to the bank, because traditional loans are only one part of its profits. The real interest-generating machine is often found inside its own customers' wallets. Americans carry approximately $1.25 trillion in credit card debt, with average interest rates close to 21%. To understand the difference, the banking system's funding costs may be several times lower. In other words, the bank obtains money relatively cheaply and lends it through credit cards at a much higher price. Imagine that one of your customers owes $5,000 and receives a minimum payment of $100 each month. The amount seems reasonable, even manageable. But at an interest rate of 21%, nearly all of that payment may go toward interest, while only a small portion reduces the actual debt. The customer feels as though they are paying it off, even though the balance barely moves. If that behavior continues, they could remain trapped for nearly a decade and end up paying thousands of additional dollars beyond the original purchase. That is the secret of credit cards. The most profitable customer is not always the person with the most money, but the one who carries debt for the longest period of time. Approximately half of American cardholders carry some balance from one month to the next. And when millions of people repeat that behavior, small differences in interest rates turn into enormous sums. In 2023 alone, it was estimated that the largest issuers earned around $25 billion in additional revenue by increasing their margins above their funding costs. But some banks crossed a much darker line. In 2010, Wachovia, then one of the largest financial institutions in the United States, admitted that its anti-money laundering controls had failed for years. More than $420 billion connected to Mexican currency exchange businesses moved through its systems. The process was designed to appear normal. Drug cartels transported the cash earned from drug trafficking into Mexico, deposited it with currency exchange businesses, and then transferred the funds to accounts in Miami, as though they were legitimate transactions. From there, the money could be moved into real estate, businesses, and aircraft used to transport drugs. The bank collected fees for processing the transactions while warning signs went unanswered. The final penalty was $160 million. No employee went to prison. You probably do not intend to turn your future bank into a tool for drug cartels. However, there is another threat capable of destroying an institution without anyone committing a crime. On March 8, 2023, Silicon Valley Bank announced that it urgently needed to raise capital. It was the 16th largest bank in the United States and managed approximately $210 billion in assets. 2 days later, it was gone. It did not take months or years to collapse. It took approximately 40 hours. Its greatest strength ultimately became its greatest weakness. The bank served a large share of venture capital-backed startups, and many of its customers belonged to the same professional circle. When the first reports of its problems began spreading through private chats among founders and investors, everyone reacted almost simultaneously. There was no longer any need to stand in line outside a branch. In the past, a bank run unfolded slowly. Customers had to travel to a branch, stand in line, and wait at a teller window. That process gave the bank time to obtain liquidity, reassure the public, or request assistance. Today, thousands of people can withdraw their deposits at the same time using a phone. And while Silicon Valley Bank was moving toward disaster, one detail was difficult to ignore. Greg Becker, its chief executive officer, sold approximately $3,600,000 in personal stock just 13 days before the collapse. It may have been a scheduled transaction, but the timing certainly did not help restore confidence. What destroyed the bank was a digital bank run. When too many customers demand their money at the same time, the institution cannot simply open a vault and return every deposit. It keeps part of its funds in cash, but much of its capital is invested in bonds or committed to loans that will be repaid over many years. Therefore, for your bank to survive, you must control 3 risks. The first is avoiding dependence on a single type of customer. Silicon Valley Bank concentrated a large portion of its deposits among technology companies and venture capital funds. Many founders and investors knew one another, shared advisors, and participated in the same private groups. When one person withdrew their money, everyone else learned about it immediately. The community that had driven the bank's growth also accelerated its collapse. The second rule is never to finance long-term investments with money your customers can withdraw tomorrow. Silicon Valley Bank received deposits that could leave at any time and invested them in long-term government bonds. As long as interest rates remained low, the strategy appeared safe. But when rates increased, the older bonds lost value because they offered lower returns than newly issued bonds. The problem was not necessarily holding them until maturity. The problem emerged when customers demanded cash, and the bank was forced to sell them early, recognizing enormous losses. The sale exposed the weakness created fear, and the fear multiplied the withdrawals. The third rule is to examine not only how much you lend, but also what truly supports those loans. Many regional banks financed office buildings under the assumption that rental income would continue paying the mortgages for decades. Then remote work reduced occupancy, many companies abandoned their office spaces, and some property owners stopped receiving enough income to repay their debts. Suddenly, banks discovered that their loans were backed by half-empty buildings whose values had fallen significantly. On paper, they still held assets. In practice, selling those assets without accepting losses had become much more difficult. However, not every danger comes from financial markets or frightened customers. The robber wearing a mask and carrying a weapon is the most visible threat, but a person with authorized access can cause far greater damage. A significant share of the money stolen from financial institutions during the past decade did not leave through the front door during a robbery. It was taken through fraud committed from inside. It could be an officer who approves a fraudulent mortgage for a relative, a teller who removes small amounts over many years, or an information technology specialist capable of altering systems that almost no one else understands. The greatest risk is not always trying to enter the bank. Sometimes, it already has an access card. All of this reveals an uncomfortable contradiction. Banks sell security, but they operate by managing risks: credit risk, liquidity risk, market risk, fraud risk, and, above all, the risk of losing trust. There is also another, less pleasant truth. The most valuable customers are not always those who deposit enormous fortunes. A wealthy person who pays everything on time may generate less revenue than millions of workers who struggle to make it to the end of the month, use credit to cover their expenses, and carry unpaid balances for years. For a bank, constant debt can be more profitable than stable wealth. After understanding the costs, the risks, and the many ways a bank can fail, one question remains: how much could you earn if you manage to keep the institution alive? Let us consider 2 paths. The first is to build a community bank. You begin by contributing approximately $20 million in regulatory capital and around $500,000 more for attorneys, consultants, research, and documentation. You should not expect immediate profits. During the first few years, deposits and loans would still be too small to cover technology, personnel, supervision, and all operating expenses. Losing money at the beginning would not necessarily mean the project had failed. It could simply be the price of reaching sufficient scale. By the fifth year, a well-managed institution could control approximately $350 million in assets. With a net interest margin close to 4%, it could generate approximately $14 million per year from the difference between what it charges and what it pays for funding. Fees, cards, and other services could contribute around $2 million more. After paying salaries, office expenses, systems, insurance, and regulatory compliance costs, net profit could approach $4 million per year. But annual profit is not always the main prize. Many owners build a bank over the course of a decade, strengthen its customer portfolio, stabilize its earnings, and then sell it to a regional institution that wants to enter that market. In that scenario, the real business is not limited to collecting dividends. It is about creating a scarce, regulated asset that another bank is willing to purchase. If the strategy succeeds, the owner could recover several times the capital invested at the beginning. The second path is far more ambitious, turning the institution into a regional bank operating across several states, with hundreds of branches and between $20 billion and $30 billion in assets. At that scale, even a small margin can produce enormous results. Net interest income could range from $700 million to $1 billion per year. Then there would be revenue from credit card fees, wealth management, business banking services, treasury services, and other financial products. After covering all the expenses of an organization, that large net profit could approach $400 million annually. That is why some investors accept years of losses, constant regulation, and the risk of disappearing within 40 hours. They are not simply buying offices, employees, or vaults. They are buying the right to position themselves between people and their money, transform deposits into credit, and charge a fee every time that money moves, is borrowed, or is returned late.